Before I continue discussing the markets, please take this moment now with helping me and subscribe to my YouTube channel. Click subscribe. Click this bell. Click all. This helps you receive a notification when I post my next videos. Next, click the thumbs up button every time you watch my videos. Okay, let's continue with the view of the markets. Sunday, February 28th, the last day of the month. So tomorrow starts a new trading week. This video, I'm going to discuss a beginner's guide of the stock market. So I'm going to read some information from the internet. Maybe it's more clear than me struggling with some words that I know repetitionally, but I may put them in the wrong content. So this is going to be kind of dry. Bear with me for a moment. Stock market is called different things. Okay, the stock market, the equity market, the share markets. It's the same thing, but different people refer to it a different way. So understand that when you hear someone say the equity market, it's the stock market or the shares market. Equity market is a market in which shares of companies are issued and traded either through exchanges or over-the-counter markets, also known as the stock market, also known as the equity market. It is one of the most vital areas of the market economy. It gives companies access to capital to grow their business, and investors, you, a piece of ownership in a company with the potential to realize gains in their investments based on the company's future performance. Hey, just because you have ownership, they write the policy of what that ownership rights are. They're not the same with all companies. Be aware of that. Doesn't mean you can walk in and claim some physical intellectual property of that company. All right, key takeaways. Equity markets are meeting points for issuers and buyers of stocks in a market economy. Equity markets are a method for a company to raise capital and investors to own a piece of the company. To raise capital, they may want to raise capital because they want to purchase another company, or they want to grow their own technology company, or buy new software or hardware or tools, or maybe buy new furniture for the break room. Yeah. Or maybe new Gulfstream airplanes for the board members. It's all public information. When a company is going to go IPO, you can read that and see it's spelled out what that money's going for. Maybe it's going to go for pay raises just for the 1% of the company. Yep. Most equity markets are stock exchanges that can be found around the world. The oldest, the biggest, the New York Stock Exchange. And then you have the Tokyo Stock Exchange, the Hong Kong Exchange, exchanges in Germany, exchanges in London, Singapore, bada bing, bada boom. Got it? Yeah. Understanding the equity market. Equity markets are the meeting point for buyers and sellers to meet. You'll see on your trading platform, refer to bid and ask. When companies are born, they are private companies. And at a certain time, they go through initial public offering, IPOs. Yes, IPOs. Big financial institutions underwrite companies. For example, you might have a company like Bumblebee recently went IPO, DoorDash or Rocket Ship. It might have been one underwriter or several. For example, Morgan Stanley, JP Morgan, maybe they team together and underwrite Bumblebee. And then they have the exclusive right to sell shares to their best clientele before they get listed on the stock exchange. And then when they get listed on the stock exchange, it's called post-IPO because it already happened. So they go on road shows, they sell to big institutions that are going to buy a lot of shares, not typically investors that are going to buy 1 share, 10 share, 100 shares. Yeah. Got it? Good. Trading in the equity market. Investors bid for stocks by offering certain prices, and sellers ask for specific prices. When these two prices are matched, a sale occurs super fast electronically. Often, there are many investors bidding up the same stock. When this occurs, the first investor to place the bid is the first to get the stock. When a buyer will pay any price for that stock, they are buying at the market value. Similar, when a seller will take any price for the stock, they are selling at market value. So typically, you have a bid and ask on whatever trading platform you use. So you as the retail customer, when you're buying that underlying stock, you be buying at the ask. And when you want to sell it you do it at the bid. The markets are closed right now. The price aren't moving. So if you're buying the ask, you're anticipating, you're buying, because if you think prices go higher, you're bullish. If you're bullish, you buy the ask. If you think price is going to go lower, you short at the bid. Yep. So what does that mean, short at the bid? If the price goes lower and you buy back lower than what you initially shorted at, you make the difference. On the ask, if you think it's going to go higher, if you buy it at this price, and if it goes higher and you sell it for the higher price and you bought it for it, you make the difference. You got it? I hope you do. You're going to be tested more. Stock exchanges. Well, like I said, in the United States, the New York Stock Exchange is the oldest, and it offers both because it originally started trading on the floor pits, and then they went electronically after the Nasdaq also went 100% electronically, so you don't have to be there. Difference between exchanges. Not all companies meet requirements to be listed on the New York Stock Exchange. They're very prestigious. So some companies, CFO, board members, CEOs, they might have done something that was ethically or morally not honest, but they're still working for that company and they want to get listed on a stock exchange, the New York Stock Exchange. Nope, you're not going to be on us. So they might go on the Nasdaq Stock Exchange or another stock exchange. Yep. And also typically on the stock market, the New York Stock Exchange, typically the stock symbols are 3 letters or less, but that's changed over years. Yep. Okay, let's go to look at some stocks, and we'll go back to what I was talking about later on and just get you some basic information here. We're looking at 2 grids. Each grid has candlesticks. These are candlesticks. Each represents 1 week. And each candle represents 1 week, but the whole duration is 3 years. So 3 years, 3 years. Top left is the SPX, the S&P 500 cash index. And the New York stock market is from 9:30 a.m. to 4 p.m. New York time. So wherever you are worldwide, use that electronic device and match it up with the New York time. Because in my videos, I refer to the New York time because I'm East Coast, just below Wall Street, in a warmer place, but same time zone. Yep. And this stock symbol is KO. Coca-Cola, old school. It's on the Dow Jones Industrial Average. Dow Jones Industrial Average is the 30 largest publicly traded stocks, and that index is also on the S&P 500. Little note, S&P 500 has 11 sectors. So Coca-Cola, it's under a sector called consumer defense. And within the sectors, you have industries. Well, this is a beverage. Coca-Cola is a beverage. It's not alcoholic. And over the last 3 years, we see, starting here, the low that S&P 500 was here and the high is there. Look, we're almost at the all-time high. Where Coca-Cola, all-time high was last year for the past 3 years, and the all-time low for the past 3 years there. Yeah, it's underperforming the index. So it behooves you to be in winners. So if I was in this today or tomorrow, good money management would not have me add any more capital to this, or maybe decide to sell and be in a winner. Yeah, here we go, winner. Another thing to mention, not all stocks stay on the stock exchange. Sometimes they get bought back and be private and come back again. Also, not all stocks have options. Options are a derivative. Got it, derivative. Open this up. This is an option chain. So Coca-Cola offers options, and not all companies that first get listed on the stock market have options listed, nor pay dividends. Facebook, for example, Facebook, Foxtrot Bravo, stock symbol, it was one of the first companies within the same year it went publicly traded that had options on it. So that policy changed. Now they offer them sooner. The point is, these options are a derivative. They have different expirations like assurance. This one's at expiring this coming week on March 5th, has 5 trading days, and these are strike prices. And each of these contracts and options represent 100 shares. I'll cover more of this later on. Let's go back to the stock. S&P 500. Yep. I chose the colors, the designs. It works well for me. The point is, I'm a technical. I don't use fundamentals to determine a buy or sell the underlying necessarily. Let's look at a few other stocks. Facebook, Foxtrot, Bravo. Look at this. So again, it's declining. So if you bought the S&P 500, you'll be doing better than if you bought Coca-Cola or Facebook. Facebook's on the Nasdaq, but it's 2 letters. Here's another one you might have heard of, Microsoft. Microsoft outperforming Coca-Cola, outperforming Facebook, outstanding. Momentum to the upside. S&P momentum to the upside. Outstanding. Maybe you heard of this stock too. Disney, 3 letters. But again, just because that 3 letters doesn't mean, but yes, this does trade on the Dow Jones Industrial Average. Do you like beef? Or are you a vegan or vegetarian? Maybe eat McDonald's if you still call that beef. Well, the point is, again, we're looking at the same duration, 3 years, and 3 years of the S&P 500. Each candle's a year. So, declining, and this is outperforming. Yep. Do you like Apple? Not the one you eat, but the electronic company. Look at those 4 letters, Alpha, Alpha, Papa Lima. It trades on the Nasdaq 100. My trading platform, right here, trading platform. Trading platform is offered your broker. It says right there, the stock exchange on the Nasdaq. Got it, the Nasdaq. Disney on the New York Stock Exchange. Just to let you know, brokers, trading platforms, they're not all the same. Some will use 20 or 30-year-old technology, and they're not free. They might market to you they're free, but then they have embedded costs in the shares. How can a company be free, product or service, if they're not making money? Think about it. Yeah. Another takeaway is trading, investing, money management is so important. Money management is so important. If you're wrong, you don't marry a trade, a position, investment. You get out of it. You can reallocate your money, put it aside in cash, and come back when you see another good investment you want to make. Not all investments will always stay outstanding. Here we have one. Tango Whiskey, Tango Romeo, Twitter. Look at that. The past 2 weeks, S&P 500 went down. The past 2 weeks, Twitter went higher. There's no reason you need to stay in your same investment long term. You could rotate. The people that manage people's money, called institutional traders, that manage other people's money, be it for government pensions or private companies or mutual funds or hedge funds, they're also looking at their best interest and their client's best interest of going where the winners are and getting out of the losers fast. Yeah. Have you ever heard of a share company called Uber? There we go, Uber. Okay. If you got value from this video, if this was helpful, then please consider sharing a small monetary donation to my channel by going below and clicking on my PayPal. You can leave a small tip. If you don't want to share financial support, no problem. Just click the like below and subscribe. Leave a comment to help my website grow. Bye-bye. If you like this market information I've shared and want to learn more with greater detail, step-by-step training, I have a Patreon page. I share trade ideas for earning monthly income. Below in the description box, click Show More. Scroll down. This link here, click on it. Take you here to my Patreon page. Select the membership and join. Then you have access to unlock my posts.